Hello and welcome. I'm Marty Ellingsworth with Celent, a global technology advisory firm. My specialty is focusing on data and analytics, especially things around AI, cloud, and advanced analytics. And today we're going to talk about making the most of a hardening market in cyber insurance. With us today is an esteemed panel, joining us from the, three corners of the world, London, Greece, and London again. Today we have with us Laura Johnson, the practice head of cyber at Chauser, Amir Kessler, a cyber risk expert and product manager at Kovrr, and Visesh Gosrani. Although I practiced that name 3 times, I still get it wrong. Chair of the Institute and Faculty of Actuaries, Cyber Risk Working Party. So today, Visesh is going to be the MC of the event and introduce the major topics around understanding a little bit more about cyber risk, the ideas of covering the space around loss ratio on a per policy level versus the book of business at large. So understanding things at a very fine-grained level, how to do portfolio steering and management in the hardening market, and especially around understanding the key characteristics of risk and how to understand how to react quicker to change. So first, let's have the panelists introduce themselves, and I'll go from Laura to Amir to Visesh, and then Visesh, I'll let you kick off the Q&A.
Thank you, Marty. Thank you for the introduction, Laura Johnson. As Marty said, I head up the cyber practice at Chaucer. Chaucer are a specialty underwriter in the Lloyd's and London market. We've got hubs all around the world, and I run both the direct book of business and the reinsurance cyber book of business. Over to me.
Hi, I'm Amir Kessler. I'm with Kovrr. I've been with Kovrr for 3 years. My background is with cybersecurity. I was in the Israeli military, like all Israelis, and an officer in the cyber unit. Then I worked for 2 cybersecurity companies, and mostly around the methods and propagation of the cyber events. I joined Kovrr 3 years ago, and I do product management, and I'm a cyber expert. I'm based in Tel Aviv usually, like Marty mentioned. I'm currently in Greece, but usually I'm in Tel Aviv.
And I'm Visesh Gosrani. Professionally, I'm an actuary, and I've been an actuary for the last 20 years working in general insurance. About 5 years ago, I started to specialize in thinking about risk selection in respect of attitude and competence. Through being connected with Arvind Parthasarathi, who founded Science, we started to apply that to corporate cyber risk. I continued on that journey after leaving Science, and have done that on a consulting basis as well. I'm also looking at applying that to wider lines of business than just cyber, but cyber is clearly a case where it matters an awful lot. I'm also chair of the Institute and Faculty of Actuaries Cyber Risk Working Party. Yeah, now I'll hand back to you, Marty.
Well, very good. So, Laura, let's discuss a little bit about the loss ratio per policy, understanding how to do finer grain segmentation.
Yeah, it's an interesting one. So I think if you speak to any insurer or reinsurer in the cyber market at the moment, we are all taking a very close look at our portfolios. And I think in prior years, we've maybe had a bit more of a broad brush approach on either certain industry segments, certain size, maybe just a SME view of risk for cyber. But that's really changed over the last year. And we'll talk about this and touch upon it multiple times throughout the session, I'm sure. But the risk itself is extremely dynamic. Things are changing rapidly in the threat landscape. And as such, the underlying loss ratios are changing too on various different accounts. So I think it is quite important to take a more detailed view of your portfolio, almost do a drains up, as we like to call it, in certain areas to understand, are there pockets of certain industries or sectors or sizes that are outperforming others, some that perhaps need to be priced more appropriately when we think about price adequacy, or perhaps even some that we just choose not to write at all based on the diversification of your portfolio and where you want to be overall with your kind of net combined ratio. It's been an interesting time, and I think we'll touch upon this, but data is obviously key to that. And I think, Amir, this is probably where you come in and can help with how do people even begin to drill down on that data and get valid results to make those decisions.
Right. Thank you, Laura. So, and it is a very interesting question, and I agree with everything you said, especially around the ever-changing nature of cyber events. And it's an interesting question to understand. And what we do at Kovrr is exactly that. We model a portfolio both on an aggregate level, but also on a policy level to understand the exposure to the different cyber risks. So we create loss ratios, again, on a portfolio level, but also on a policy and risk level, and try to understand their exposure to all the type of cyber risks there are. Now, our model consists of three parts. The first are the catastrophic events. And I think in many ways, this is the big mystery, maybe in the cyber world. What are the cyber catastrophes and who are exposed to these catastrophes? And what we have, we model a very comprehensive event catalog of all the potential cyber catastrophes that can happen. And obviously, we use our cyber knowledge to create this catalog and understand the risk. And for every company, we attribute the exposure to each of these catastrophes. So we can predict what catastrophe will affect which company and what will be the size of the damage. And this is a major contribution to the loss ratio. But additionally, there are more types of cyber events. There are also large loss events that in the cyber, for cyber, mainly it revolves around targeted attacks. So we know that when you look at cyber attacks, a lot of the attacks are targeted to specific companies, to specific enterprises. And they try to steal their data, maybe credit card data or just any other sensitive data, maybe create an outage. And these targeted attacks are also very dangerous and can create a lot of damage. And we model them, and we model the exposure, each of the policies in the portfolio to the potential targeted attacks on them. And the third part, which is might be the smallest, but not least important, is attritional loss. So also in cyber, you have attritional loss. It could be the phishing mail that is sent to only one person. It could be a PC that was stolen, maybe a hard drive that was stolen, and can create actual material damage. So we also attribute to that, and we unify our simulation and create a loss ratio for every policy that predicts the amount of a loss that we predict. And this loss can be used to increase profitability and change the premium, but we also provide transparency and to help the underwriter understand what caused this loss. What are the type of catastrophic events every policy is exposed to? What are the main exposures of the portfolio in general? And this loss ratio, given with the transparency to the model and all the information about the exposure, can help to price and understand the risk in high accuracy and high confidence, which is very important when you're trying to price or reprice a policy. So yeah, this is what we do.
And I think it's, oh, sorry. I was just going to say, I think it's important to bring out some of why it's so important at this stage in the insurance cycle to have that type of knowledge. You know, the last few years have seen significant growth. As we move forward, economic conditions are likely to mean that growth is suppressed from the sort of the levels that we've seen in recent years, because cyber still doesn't have huge penetration. It's got a lot of potential going forward, but the penetration growth in coming years is going to be stifled because it's a new purchase. If you're renewing it, it's slightly different. So actually coming back to some of Laura's points about, you know, bucketing your portfolio and whether that be on an individual basis or an exposure buckets basis. And Amir, maybe later on we can talk about the CRA zones concept in respect of that. It is really important to get a handle on what is it that you actually want to do if you are also being constrained in terms of capacity, because on the flip side, there's a regulatory aspect whereby some insurance entities are having capacity limitations put on them, whether it be from an external regulator or quasi-regulator, or even whether it be boards just concerned about their overall exposure to cyber risk.
Well, that's a really good point. I think the idea that the boards are being concerned and the innovation scoring of companies are being concerned around what is the data security supply chain, what is the cyber risk supply chain, how far out does it go? I've been in property casualty insurance for about 20 years, and before that, about 10 in healthcare and about 10 in the military. And all of those industries have a idea of provenance and proprietary content and safety and security. In insurance now, there's also this mass consumerization feeling around. During COVID times, we're all working from home, and we have lots of different experiences with kind of the Amazons and the Facebooks and the Googles and Microsofts and Apple even, around how it should be easy to do things. And so this idea of ease of doing business, price for sure, and peace of mind is the part of risk transfer that makes the insurance industry help the world get on with doing business, is they manage the risk in a comfortable way. But pricing, especially for emerging risks, over the 2 decades I've been in P&C, some of the oldest types of giant risks that are emerging and have been emerged for maybe decades, things like asbestos, very long tail, things like other product liability, where you've got links in the chain of risk that didn't expect to be hit, that because it is a large loss, coverage is like, well, you should have taken better care of the security. And it's like, well, you should have secured the cloud. No, you should have changed your password. How does the management of portfolio steering with all these different types of risk and mitigation and liability, open up? And I will recognize that October is the National Cybersecurity Awareness Month. How do even the top of mind board of director, risk management, entities, think about, the emerging risk of cyber and how fast it's been emerging, especially in the last, year and a half.
Yeah, I'll pick this one up. I think it's interesting when we talk to some of our clients on the direct side of just how important cyber risk is to them now. I would argue for the large corporates, it's been on the board agenda for a good 5 years. Your large FIs, your retail, certainly healthcare and any kind of tech-enabled companies, the big tech companies out in the US. It's been on their minds. But I would say what's happened is your SME are suddenly very focused on it because they're seeing the pain from other people. It's quite well known and well reported that a large percentage of SMEs will not recover from a cyber attack. It's the end of their business. Now, those that are reasonably new and have taken a cloud first adoption strategy to their business have benefited in the COVID landscape because they've been able to scale or respond. And there is a belief, whether it's right or wrong, I can go into lots of technical detail, but there is a belief that it's inherently more secure in the clouds than perhaps a PC under someone's desk. With my technical background, I'd argue that it depends very much on how you configure your cloud instance. But again, that's where we can surface some of the information from other attacks and other kind of outside in view of risk that can give us some of that information. But the option of risk transfer is key. And what we're here to talk about today is kind of from an insurance portfolio, is it the first thing on their mind to think about risk transfer into an insurance product? And I think that's where the challenge is at this point in time. For the large corporates, it's been something that they've been used to. In some cases, it's not necessarily mandatory, but regulation encourages the purchase of insurance, and in some cases does mandate it. But in some of the other industrial sectors, for example, it's not mandatory, and it's something that is seen as an evil necessity, certainly in their other kind of classes of business. So there's a lot of new products out there that are trying to offer a solution rather than just an indemnity payout. And they do provide some of that risk assessment capability, cybersecurity, maturity assessment, to not only make it a better, risk profile for the client, but also a better risk to the underwriter at the end of the day. And I think that's where the market's really moving to. And it, again, only feeds into the more and more need for data and information sharing, which can be challenging in quite a censored landscape in most cases.
So Amir or Visesh, can you talk about how to manage portfolio steering and understanding these changes over time as they're kind of rapidly moving? How to do better mitigation and how to do portfolio level, and policy level, risk underwriting.
Yeah, I'll touch on that and then I'll pass over to Amir. But before I do that, I would absolutely echo some of what Laura's just said. The fact that you're taking a cyber risk policy to protect you against cyber risk, and that financial indemnity is great, but it's the services, the post-breach services are the ones that everyone thinks about, but the pre-breach services means that you're aligning yours and the insurer's interests. They're not providing it because they're a charity. They're providing it because they don't want you to have the risk they don't want you to have the event in the first place. It costs them and it's headache for you. But when you're thinking about portfolios at an aggregate level, there's only a certain amount of detail that you can actually get, especially if it's a smaller entity and it's harder to get the detail. You want less friction in that process. But what you can do in terms of a lot of these entities is understand where are their aggregation points, what are the technologies that they're running, what are the services that they're actually using. Can you see specifics that actually mean that you recognize that these are the most critical services and technologies from them? Does that tally up with what was in anything that they submitted to you if they did? And does that give you an indicator of how competent they are? Now, all of these things need to be balanced against the actual time that you have in order to do this. And as we move forward and we all mature, you'll balance off the fact that they also use the same cloud service provider that you have an awful lot of exposure to, with actually they display an awful lot of competence and the right attitude in everything we can see about them from an external perspective, and maybe from any interactions we have with them. But coming on to sort of portfolio steering, I mean, as you start to recognize that you have a buildup of exposure, then it's really important to think about, well, this particular policy for me, how does that diversify my overall risk? How much is there a relationship with the insured that means that I really need to write this one, and I need to make sure that I manage my total exposure to particular aggregation points in the longer run as well. And this is without thinking about the exposure that you have to these cyber aggregation points from your non-cyber book. I mean, right now, if we won't open that can of worms today, because there is exposure from your non-cyber book, but clearly we're maturing much faster in how to assess it from the affirmative cyber book, and we need to be adding in some crude measures over the longer term to at least enable us to measure that across the breadth of cyber policies we have. And I think Amir, just passing to you would be really good, just to at least hear about CRA zones concept in terms of thinking about this, as well as anything else that you'd like to add.
Of course. So CRA zones are really relevant for diversification. And I think that even before explaining about CRA zone, I just want to say one sentence about Visesh, what you mentioned, and also Laura mentioned, that the exposure to cyber events depends critically on the services and technologies that companies use. So only looking at the location of companies, unlike, which is enough for a natural catastrophe, is not enough for cyber, and you really need to understand what types of technologies and what types of service providers are being used to understand the exposure to cyber events. And Visesh, you also mentioned that this might create a bit of friction with an insured, as this might be hard to collect. So there are also automatic methods to do it. So for example, what we do is automatically scan a company using only minimal data to try to, and we detect what services and technologies are being used by that company. So we have this initial observation of the exposure of each company. And what we do is we aggregate it using CRA zones. And the concept of CRA zones is something that is quite simple maybe to explain. It's a combination and aggregation using 3 parameters: location, industry, and company size. Now, what we have seen is that companies from the same CRA zone, meaning they use the same, they are from the same industry, same location, and the same company size, have a very high correlation with the technologies and with the services that they're using. Meaning companies from the same CRA zones are exposed to the same cyber events. Now, this makes sense, but of course we have validated with the research that we've done, statistical research, and we're going to publish a paper about it very soon, so stay tuned. And once we understood that this aggregation method of CRA zones is the key, or is the best method in order to aggregate risk, we use it to help diversify the portfolio, to help underwriters understand how the risk aggregates, to understand how the risk aggregates on a portfolio level. So we show and we reflect for a portfolio all the CRA zones that are in the portfolio, and we give, for example, information about the profitability of every CRA zone, which CRA zone is good or bad in the sense of how much profit it makes, what is the TVAR contribution of every CRA zone, and also what is the correlation between each CRA zone. So I'm just giving a few examples to show how you can use this aggregation method as a framework and to help to understand how your risk aggregates. Now, we also automatically create underwriting guidelines using the CRA zone and using the technologies and services that we have detected. So if on a portfolio level, we see that some CRA zone has reached the full capacity or is more dangerous because it's too big and it's exposed to too many events, we reflect that in the underwriting guidelines to make sure that no more risks from these CRA zones are on board, or maybe they are on board with more premium, etc. Now, besides just creating these guidelines automatically, of course, this CRA zone concept and this understanding of how your risk aggregates in cyber can also be used for other products, like you've mentioned, maybe to for risk transfer or even to buy a parametric solution. So it's a framework, and how you deal with the exposure that is reflected through the framework is up for the exposure manager and the underwriter. But the idea is to reflect it in a domain and in a framework that is fit for the cyber world.
So Amir, let me bridge off that and say, you mentioned, size and industry, are there in location, of course, but the idea that risk characteristics that can be, scanned easily, sometimes they do or don't include, who they're doing business with, how they're doing business, all the points of their connectedness as a business. I know that I've done a lot of work in IoT and connectedness for personalized business with cell phones and smart homes and smart cars. So those are all massive points on a surface for a cyber sensitivity. But when it comes to businesses, even if they think they don't hold lots of data, is how small is too small? Are there any industries that, if you look at a portfolio level, that are bigger hotspots right now than others? Because Laura says that the big companies have been risk aware and have been managing both reputation and technology. 5 years seems like a long time this year, but it's not that long ago. Where do you see the CRA zones dynamically changing, right, in the COVID period for sure? And are there any risk characteristics around how to be faster, minimize quote time, or even manage concentration more dynamically as this market is starting to evolve?
So first of all, regarding the CRA zones, of course, like everyone else, we have seen a shift during the COVID. You can see it even not by examining the CRA zone, only by looking at the threat landscape. So we are monitoring different attacks and different attack groups that are out there in the wild. And like you can see in the news, we have also detected this change and this growth in the cyber potential and in the magnitude of cyber events. COVID has led all types of companies to raise their dependencies on their digital assets, on their network. Everyone is working from home. And I'm afraid to say, or I'm sorry to say, that for some people, this is a potential. This is actually good news. So there's more potential profit for attackers. There's more potential platforms. And unfortunately, I think I can say that it's something that is happening across the board. It's not a shift towards a specific CRA zone or a specific company size. Every type of company from every location and industry is potentially exposed. Cyber has no geographic borders, and it's unfortunate, but it is the way it is. So that's regarding your first question. And regarding your second question of connectivity, and another thing that is very important to understand is that who you do business with or which service providers you use is a very interesting and very important factor in your cyber exposure. So what service providers you use, for example, and it could be small and it could be big, it could be any type of service providers, or what technologies you use, like you've mentioned, IoT devices, determines your cyber exposure. Part of our reflection of the exposure is done by us also reflecting the type of technologies and services that are being used in the portfolio. Sometimes these facts or these exposures are actionable. Sometimes if you know that most of your portfolio is using a specific provider, you can avoid maybe onboarding more risks that use the same provider. But sometimes it's even, it's impossible, because if you have a high exposure to AWS, it's very hard for you to avoid onboarding AWS. I'm sorry, is the largest cloud provider in the world. It's by Amazon. You might not be able to avoid onboarding risks using AWS. So this is why we offer, first of all, we reflect this fact and maybe allow you to think of other solutions to deal with it, and also reflect on a CRA zone level and your exposure to be able to diversify on that level.
I think on that point, actually, it's worth adding that, unlike, and I know a lot of the audience here will be au fait with cyber, but for anyone who's maybe not been in cyber for so long, it is definitely worth adding that the characteristics of your risk and your aggregation points are more likely to change with cyber than they are with any other risk. If you're thinking about your geographic location in respect of natural catastrophes, it stays the same, and the paths of natural catastrophes, whether they be windstorm or whether they be a fault line, are the same. But actually, a market can start to move from one provider to another. It's unlikely to be a significant shift, but the difference when you continue to keep monitoring your portfolio on some sort of regularity means that you're aware of any of these shifts happening, means that you're aware that actually you're becoming much more exposed to a particular aggregation point, or you're diversifying away, and therefore you have the freedom to write much more. But at the same time, for every one of those aggregation points, the performance itself is something that changes at a faster pace than it does for cyber risks. So for example, you might actually see that a number of providers are just having less downtime incidents, and so therefore it is the impact of a severe incident might be so much less than you might have assessed a year ago, allowing you to write that much risk. I'll give you just one last point before I hand the mic back. The ILS market is in its infancy, but as you start to recognize that you have these exposures and you really do feel that it's okay to take a particular exposure onto your book and then singularly take that exposure out of your book using an ILS instrument, the market is likely to be more accepting of it because it is something that can be priced using data. It's in its infancy right now, but we're seeing transactions occur over the last year or two that do take specific elements of a book away and put that out into a market that's hungry for new investment ideas.
All right, Laura, it looks like you've been waiting to come in. Let's hear more about what your actual on the ground experience is seeing in the, I won't call it cyber storm, but the connected cyber environment.
Happy to weather the storm. No, there's a couple of things, and as you've been talking, a few things to pull out, draw out in terms of what actually goes on. First and foremost, we had a really good question come in through the chat around many customers don't believe that they have records, like a number of records, and it's all about data breach kind of thing. How do we change their mind? Well, I think we're talking at the moment about large service providers, large IT service providers, software as a service providers, or maybe infrastructure, etc. And really what we're getting at there is the type of cover around business interruption and contingent business interruption. So we often use the word breach, perhaps technically incorrect. It's an incident. It can be a cyber incident. It does not mean that there needs to be records being breached. It doesn't mean that there is data leakage necessarily, but the cover has now progressed to the point of offering business interruption should you have a cyber loss, and in a lot of cases any kind of system failure as well. So the product itself has morphed and matured over time, and we also see contingent business interruption being included. Now that's a cover, for those that aren't familiar with it, where I, maybe as the corner shop or the florist, dependent on the use of Amazon or maybe Gmail, Office 365 as an example, and that service provider is then covered under my policy. If they go down for a period of time that goes above and beyond the wait period or the retention of the policy, depending on how it's set up, then I can claim as a result of damages to my business, loss of income to my business. And I think that's where this really comes into play, because that's where you need to understand your hotspots, your accumulation of using these different service providers. But it's also relative as well. So we talk about Amazon, one of the biggest providers out there, and Microsoft's another provider out there. And I think, yes, it's very difficult to adjust your underwriting risk appetite to say we're not going to write anyone else that uses Amazon. You wouldn't write a book of business. We wouldn't ever grow as an industry. It's going to happen. But what we need to consider is, what region are they in? So that's where we start to add the multiple dimensions to the data set. So if they're all in a certain region and that region goes out, you may have some systemic issues there. But realistically, there's multiple regions throughout Amazon's infrastructure, same with the Azure infrastructure as well. And if you get that spread of risk throughout those cloud providers, then you're reducing some of that potential systemic loss. We've talked a little bit about systemic loss, and it's definitely a hot topic from the regulators. All of us in the Lloyd's market are probably sick to death of filling out systemic loss papers and numbers. But actually what's hurting the market at the moment is the attritional loss from ransomware, particularly in the SME markets. So we're seeing that, really hit people's underlying books of business and chip away at that overall loss ratio. So I think that's something to consider, and the fact that, as Amir touched on, we can model the portfolio from an attritional and large loss perspective as well is really key to having that view of risk all the time. There is large loss in the market as well. We can't get away from that. And whilst the larger companies, your FIs, etc., are more risk aware, they've also got more goodies to go after. And we are seeing much more sophisticated criminal actors. We've been tracking APT threats for many, many years, but they've really ramped up in their, not only their funding, but sophistication of attacks. And that's what we're seeing, you know, some of the attacks in the news that's causing pretty significant business interruption, and sometimes a secondary ransom for then data leakage and paying a ransom to avoid actually sharing that information on the public domain. So the type of attack again has changed, which why I think it's so important to manage each of those areas. Just one more point before I hand over. We have a focus on what COVID has done, and there's often a negative tone to the change, particularly in the cyber market and the potential for further loss. But it also presents opportunity. I think we need to, factor that in. We did kind of mention before that the market could be stifled in terms of growth, but that's not actually what we're seeing at the moment, which is good news as insurers, though something we will need to manage carefully. As people are more reliant upon technology, it will become necessary for them to buy cyber insurance because they can't deal without it, just as they wouldn't, avoid purchasing property insurance for their office block. They're going to need that cyber insurance if they become so dependent on the technology. I think people are also more aware of their reliance and the interconnectivity as well. So in the supply chain, the need for that contingent business interruption cover if they choose to select that as well, and obviously pay for it. So I think there's opportunities. There's certain pockets of industry that are coming to market than they ever have before as they become more aware of the risk and more reliant.
Well, I liked how you said the big companies have more goodies, and then everyone else starts to say, well, what assets do I have, and how important is it for me to run my business? And the changes that have been covered a lot, by Celent around, the technology transformation and the movement to digital puts almost all the goodies now into a digital framework. So Amir, what's the way of understanding, better the portfolio characteristics, the risk characteristics, and how portfolios react, to the changing threat landscape as more and more companies are, doubling down, tripling down, quadrupling down on, becoming e-commerce, digitally driven, and like fully transformed into, mobile first or mobile second or AI assisted, data-driven companies.
Right. So I think that, first of all, of course, all of these changes increase the exposure. But I think the interesting part here, and this has to do with something that what Laura just said, is that this exposure increases, but in a seamless way. So a lot of companies, they don't even know that they're exposed to cyber by starting to use an e-commerce platform or just using Amazon as their service provider. It's not something that comes to mind once you open e-commerce website in your company, that from the second you open it, you're exposed to a cyber event. And this fact that it's so seamless, it's what's so dangerous about it. And this is why I completely agree with what Laura said. And this is also the way to attend to companies that think that they're not exposed to cyber events, because these VI incidents are very common. And usually when we analyze portfolio, we see it as one of the major factors of damage for portfolios. And I believe it's due to this fact. And it's really critical. The second thing that also Laura has mentioned is the rise of ransomware. So ransomware is the buzzword now in the cyber world. More and more attackers understand that why should I just steal data, or why should I just create a denial of service or an interruption in a network if I can also charge extra money for it and ask for a ransom? And we see more and more ransomware groups. And what's interesting is that we see a shift from groups that have dealt with data theft to dealing with ransomware. And this is a double trouble because it can affect you in two ways. It has two impacts. You either pay the ransom or you need to pay a ransom. And you also need to deal with the fact that your data has been stolen or deleted, or you experience the BI for a certain amount of time. So these two factors, the fact that the reliance on cyber is increasing and the fact that ransomware attackers or ransomware as a threat is increasing, creates more potential damage, but also, of course, more cyber insurance potential. And it's the sensible decision to have a cyber insurance in this world, and given all of these threats. So, yeah.
Can I actually? I'd probably pose a question back to both Laura and Amir on what they've just said, because it's clear that the attritional element of the loss ratios has been much better in prior years, significantly better, and there was much more ability to weather a catastrophe when it did happen, because you had that additional buffer that the market could withstand. And we've seen years of softening rates as those catastrophes have not come through. And Amir, you've just been talking about the ways in which the nature of some of these attacks have changed in order to become more severe. It's also clear that with cyber, there's new forms of attack that will come into the future. So I was just going to ask both of you how you deal with it respectively from both a modeling and an underwriting perspective.
Yeah, I'm happy to go first on that one. How do we deal with it? There's no magic answer to that one, I should say. First and foremost is don't have a rigid approach, right? You can't set your business plan 2 years ago and your risk appetite and expect not to have to review it on a very regular basis. There are going to be things that need to change, and unless you've got a crystal ball, and hopefully it broke in 2020, then you're not going to know the answer of what's going to happen going forward. So I think remaining very agile in your underwriting risk appetite and your overall capital allocation to cyber is key as an organization. Having the ability to view the data that you need and make decisions off that data is obviously going to be key. I think the other thing that's happening as well is the market's finally starting to harden, something that it's been pretty soft for quite a few years, where cover was expanding and expanding, throwing in everything, including the kitchen sink, and rate really wasn't there for some of this cover, whereas now we are starting to see the market turn as a result of that attritional loss. And when pricing gets aligned to the risk that we're underwriting a little bit more, we will then recover some of that buffer that we need. But that's a slow process, and it's not something current insureds are going to be able to stomach, particularly in this economic climate, to suddenly have a 10 to 30 point increase on their insurance policy, their cyber insurance policy. So I think it will happen slowly, but it's a positive dynamic of the market right now.
So you think that might be a real softening because any rate increases are not going to keep pace with potentially the increase in potential losses?
I think it's one of many things that we need to take as an approach. I don't think it's going to be aligned. No, it will take time to get there. But the market's also looking at other approaches. So price isn't going to fix it. That's not going to be the only option. We're looking at coverage and restriction coverage more. Deductibles are another area, certainly on SME policies. I mean, you can get cyber SME policies that are almost a zero deductible. And if you think about even your home insurance policy, you could have a higher deductible than what's on your cyber insurance policy as a business, and that doesn't make sense at all. So I think deductibles are something that's being looked at across the board, coverage, pricing, and then risk selection as well. So all of those things combined, plus an increased awareness when we sell the product of improving their cyber posture, will all go hand in hand and work together to improving the overall state of the market.
Okay, thanks. And sorry, Amir, your side of that, dealing with those that evolution.
Sure. So it's a subject we've been dealing a lot with at Koverr. And so, like we've all mentioned, the cyber world is ever emerging, ever changing, and you have new type of threats, new type of attack vectors, propagation method inside networks that are changing and emerging every day. Now, it's very tempting, I think, and I've seen it not only in the insurance industry, but also in the cybersecurity industry. I've seen attempts to try to model it and try to predict and try to have a full view of everything that is currently going on, but also will potentially happen in the future. And what I think and the way that this world works is that it's impossible. It's always changing, and there's always new ideas, and there's always something you haven't thought of. And this is a fact. And what we're doing at Kovrr, instead of fighting this fact and just trying to chase it and try to think of all the possible solutions, we embrace it in the way that we shape our event catalog, or the way that we look at events. So even though the attack vectors or the different methods to reach companies or to move inside companies might change, there's one constant thing for cyber events, and that is the impact. The impact is always the same. It's either a data theft, data deletion, denial of service that we have mentioned here, or a few other impacts that always happen. So the way might change, but the final destination is always the same, or at least one of a few options. And the way that we use this fact is that in our event catalog for systemic events or even large loss events, we have a high variety of all of these type of impacts, all of these combination, also with different intensities. Now, the reason we do this and the reason why we control to have this comprehensive set of impacts and the way they combine is this is the way for us to assure that even if an attack happens that is currently unknown, the impact it will cause is most likely already in our event catalog, even if we haven't parameterized it exactly the same with the exact same attack vector. The impact is the same. And since the impact is the same, we model it. And if we model it, this means it will appear in our prediction, it will appear in the loss ratio. So this approach is the way to deal with this change and to still predict in this world of uncertainty.
So I like how the idea of modeling scenarios gives you an impact zone, and then the ability to do a per policy review of how did that policy contribute to the impact, gives you kind of an action pathway of now what do you do on a policy by policy basis. Not just to rewrite your book or to renegotiate pricing in a hardening market, or to influence terms and conditions, but also how to reaggregate your risk and how to put on new business and go ask for more capacity. Because when an opportunity presents itself to grow profitably, having capacity is important. Laura, where's the market heading in I'll say 2021, because 3 years is too far ahead for anyone to think right now, but 3 quarters is probably reasonable.
Yeah, and I think the key to your sentence just there is growing profitably. And if you don't take action on the parts of your portfolio that aren't performing well, then we will see, as we've seen this year alone, carriers pulling back from the cyber market. That's inevitable, particularly in the landscape that we're in, when you've got other losses coming in that are impacting a company's overall capital. So I think it's key to be mindful that you need to act fast where there are changes, and stay on top of those changes. There's growth potential there. The market isn't particularly flooded with capacity at the moment. There is a lot of re-underwriting of portfolios occurring at this point in time. And at this point in terms of cyber reinsurance, there are the main players out there. There's a few smaller markets as well, but there is starting to become a squeeze on that reinsurance capacity, which is only going to drive downwards issues on the direct market as well. At this point in time, there is a very nascent retro market, and until that really grows, I think that the position is going to be interesting for the carriers that are still around, looking to grow.
And continuing that sort of thinking about the market hardening and the reaction to it, You talked about how you're changing your exposure to some of these policies and potentially changing the coverages and the breadth of coverage that you've offered. How does that play in from your estimates of the extent to which that's having an impact on the losses you're exposed to? And again, back to Amir as well. How, from a modeling perspective, how do you feed that back?
Yeah, so I think it's key to almost run it from a scenario perspective. You can have a portfolio with an attachment point and a certain scenario that will generate X amount of attritional and large loss. If you start to move some of those attachment points on the portfolio and rerun against that scenario, that's where Amir's side of things really comes into play. So you can see the impact of those changes to the potential losses based on the events that they've experienced so far and that are in the database. That's really a key driver for managing your exposure going forwards and how you look at your overall kind of risk appetite and capacity. Amir, do you want to add to that?
Sure. So on the modeling perspective, appreciating that the changes of wording of coverages or the usage of attachment point of coverages is a used method, what we do is reflect the risk and the exposure on the scenario base. So we don't just give one loss ratio or one AEL for a portfolio. We show both on the aggregate level and also on the policy level how the risk reacts to each of the scenarios. So I mentioned the impact-based approach that we are taking. This is also reflected in the results. So you can see how exposed you are specifically to BI or specifically to a ransomware. And then you can change your coverages or change or buy other or do a risk transfer accordingly. The impact on our scenarios are aligned to the coverages that are most known or mostly used in the market exactly for that. So it could be easily used.
And I think that, sorry, go on.
No, go ahead,
I think as portfolios grow, that ability to do the analytics on the portfolio and understand where your exposure is coming from is going to be really key, so that you can understand what it is that you might need to temper, or how there might be aggregations with other lines or other parts of your portfolio more widely, and then even work out what might be able to hedge against that. I was just going to call out the time and say that we're at sort of 10 to the hour, and almost think about whether we throw the floor open to any questions, and potentially get, while we're waiting for any questions, go around everybody and play back some of the main points from today.
Absolutely. So with 10 minutes left, I think we should focus, and Kovrr will be taking the questions that are attributed to the question, person asking the question, and try to get back to them directly. It's hard to do those things live and make everyone fair and equitable. One of the things I wanted to wrap up in my summary is, one, how do you make the general public and the business owners more cyber aware? Two, what's your advice to your peers in the companies that are managing technology risk, data risk, cyber risk, of how to learn more about the risk they don't know, and how to consider more the terms and conditions of how they engage a cyber product for what is covered, what isn't going to be covered, what can they mitigate smarter, how do they set up services so they don't have a single point of failure. These ideas of getting to cloud at all versus being multi-cloud versus being cloud federated. Some of the people, a lot of companies I know are actually cloud by proxy, because they have services and APIs already attached to a variety of services that are kind of just handled in the cloud. So the idea of how do companies engage the risk, and how do they put themselves into portfolios? That's more of, when I talk to my customers, they're all going to be saying, well, how do I understand what my risks are, and how do I find protection for them in the market?
Sorry, Visesh.
Yeah, sorry. Okay, maybe each of us will take it in turn. I was just going to say, in terms of my perspective, what I see is that if you're larger, typically you'll have a broker who's much more prepared to take the time to educate your board on the risks and give you an idea of how those risks have changed over the last year and what it might be that you might now be more exposed to and how your coverage should change. But even for the smaller entities, there are more and more offerings whereby there are not necessarily tailored training courses offered, but courses you can watch to bring your cyber risk awareness up, to bring that of your employees up so that they can understand what the different types of attack mechanism are. I think that one of the big flaws with companies understanding still today is the fact that if I roll out a training program, I'm going to be so much better protected. I think the one thing that I haven't seen companies getting past is the fact that it just takes the weakest link to allow an attacker to get into your organization. And I think finding a more engaging and fun way to raise people's awareness without them thinking of it as training is really important. Sorry, I'll pass on to Laura or Amir.
Amir, do you want to go first?
All right, thank you. So I think that having a modeling solution and that reflects the types of exposure, both on an aggregate level and on a policy level, can help with both of these problems. So of course, then on the aggregate level, once you see, for example, in the framework of CRA zones or by technology of services, what you're most exposed to, and what are your aggregation points, and it naturally raises the awareness and the understanding of the way that your risk aggregates, and it can help you better deal with it. On a company level, I think that once you have a modeling solution that is also able to reflect how different risks or different companies are exposed to cyber events, you can use this information to show companies how similar companies from the same CRA zone, for example, that share the same characteristics are exposed to events, or even how much they are exposed to event, in order to explain that if they are exposed, you are exposed as well, since you share the same characteristics. I think it's a valid argument, and it can be eye-opening. Yeah, Laura.
Bring it home, Laura.
So I think I'll wrap up how I started my conversation in the fact that the market's extremely dynamic and one size doesn't fit all. If you are a purchaser of insurance, you need to shop around. You may need an industry specific product to meet the needs of your business. That's something to consider. Look for the right product that suits your needs and has the coverage that you as an organization requires. And if you don't know what you require, as Visesh said, there is lots of analytics out there and even policies that will help you identify what that risk is. Cheapest isn't always best as well. That's something to consider. It's just the same as any product that's out there. It may be a tick in a box, but really this is there to help you, not just be a paper exercise. And for insurers and reinsurers, the market is extremely dynamic. We can't sit on our laurels. We can't just wait and expect the market to do things and change for us. We need to actively manage our portfolio, identify areas of opportunity and manage those that are of concern to ensure that we continue to write a profitable book of business.
And I'm not trying to scare anybody, but career criminals, cyber criminals, ransomware, theft of data, anything that is a crime for profit, type of exercise, has an active tribe of very smart people constantly looking. And maybe once a year isn't enough to reassess things. So not to scare the crowd, but think early, think often, and think frequently around the changing exposures, where you fit in a CRA zone, and the type of threat landscape that you're currently in, and what's coming. So thank you all very much. Great session, great panel, and I'll have Naomi at Kovrr or Amir help manage any of the questions that we couldn't get to today. Thank you all very much.
Thank you very much,
you.
everyone. Please reach out to Koverr if you have any questions. Thank you, Marty.